Hello guys, welcome to my channel. So if this is the first time you are coming across my channel, you're welcome. And then basically what we'll do here is we're learning forex trading together. We're going on this journey together, and I'm carrying along my forex learning journey. Alright. So please do me a favor, like this video if you haven't subscribed yet and you feel that this content will be helpful to you. Please do well to subscribe and then leave a comment and then a share will go a long way. Thank you very much. So today, on my journey to learning for forex trading, we are going to be looking at the forex market size and liquidity, right? Basically, so as we all know, or if you don't know, the bulk of forex trading takes place on what is called the interbank market, right? Unlike the financial markets, the New York Stock Exchange, that's the NYSE, or London Stock Exchange, which is the LSE, right? Which is the LSE, right? So these are the major markets in which forex exchange or forex or FX, whatever you call it, takes place, right? So the forex market has neither a physical location nor a central location or a central exchange, right? So the forex market is considered an over the counter, that's what is known as the OTC market, due to the fact that the entire market, right, electronically operates within a network of banks and non-banks in non-bank institutions. Sorry about that. So continuously over 24 hours, over a 24 hours period. So basically, like I'm saying, it's the forex exchange market operates what is known as the over-the-counter market, which is the OTC, within a 24 hours period, right? So within 5 days. So if you are doing an introduction to what is known as forex exchange, right, you'll be aware that the over 7 trillion dollars is traded on a daily basis within 24 hours a day, within 5 working days, right? Basically within 5 working days, where currencies or currency pairs are being traded, right? Maybe like you say, the USD is traded against the USD will be in your base this thing. Which being your base is traded against the quote, which could be like the euro, or it could be interchanged the other way around. So this is done 24 hours in a day, right? And then basically within 5 working days. So basically that's what this is talking about. And this means that the FX market is spread all over the globe with no central location. Trades can take place, right, anywhere as long as you have an internet connection, right? And so these trades take place within and the major currencies that are majorly traded. That doesn't mean that other currencies are not traded. We have the cross currencies which can also be traded, the minor currency, the heavy currency, right, which can also be traded, right? So but the major currencies which are mostly traded on the FX market, which is the Euro USD, the USD Japanese yen, the GBP USD, the USD, the USD traded against the CHF, and then the USD card, the odd USD, and then the New Zealand dollar traded against the USD, right? So that's basically how the market works. So you also know that the dollar is the king of the forex market, right? According to the International Monetary Fund, the IMF, the USD comprises roughly of 62% of the world's official foreign exchange reserves. There are also other significant reasons why the US dollar plays a central role in the forex market. Number one, which is the US economy is the largest economy in the world, right? Number two reason will be that the US is the reservoir currency of the world. Number three will be that the United States, right, has the largest and most liquid currency and financial markets in the world, right? And the final reason, but not the least, is the US dollar is the medium of exchange for many cross-border transactions, right? So briefly, we are going to be looking at the speculations in the forex market, and the main functions of the forex market are: number one, to transfer funds from one currency of a country to another currency. Number two main function of the forex market is to provide short-term credit, right, to finance trade between countries. The number three reason is to avoid or hedge against foreign exchange rate functions from when a transaction is initiated and when payment is received. And then the final and most important, in which most forex traders do, is to speculate. Right. Now note that while commercial and financial transactions are part of the trading volume, most currency trading is based on speculations. In other words, most of the trading volumes comes from traders that buy and sell based on short-term price movements of currency pairs. Now, briefly, let's look at market liquidity, because I don't want this video to be too long. So we'll look at market liquidity, and then probably in my next video we are going to be talking about currency pairs. Majorly we are going to be looking about on currency pairs, but let's look at market liquidity. So you want to stick around. That's why I said subscribe, so that you'll be able to get notifications when my next video comes in, and then we'll be able to grow on this journey together, right? Like I always say, no one is an island of knowledge. This is a continuous process of we can grow together, learn together, unlearn together, right? Learn new things together. And why not, if you have something that that I can also learn from you, you can drop it in the comment section. I'll go through it, I'll learn, and possibly come and share on it. And if there's anything you have listened to me say that you feel that is not in line, right, or I could gain more knowledge, you can also share with me in the comment section, and I will look to it and then come back to give you appreciation for that. So briefly, let's know what is market liquidity, right? Market liquidity is the ability to buy and sell a large quantity of something with minimal price impact, right? Very high, with minimal price impact, very high, right? You know that from the perspective of a short-term trader, liquidity is very important because it determines how easily a price can change over a given period of time. So basically, liquidity, right, is the ability to buy and sell a large quantity of something with minimal price impact, right? So when you can easily buy something and sell it, that means that product or commodity is highly liquid. So I think this is the fine place to put a full stop for today. I believe that in my next class or in my next video, we are going to be learning more. Like I said, we are going to be talking about currency pairs. So I'd like you to hang around, subscribe, leave a comment, like this video, and if possible, share it to people who you think this video might be helpful for. Thank you, and see you in my next one. Ciao.